All right, hi everyone. Welcome to today's IronFX webinar on the oil outlook for the second quarter of 2025. Right, before we begin today's webinar, please take note of the disclaimer. Right, the information is not considered as investment advice or investment recommendation, but instead is just marketing communication. And also take note of the risk warning that comes with trading the products here on IronFX, right, as they're traded on margin and carry a high level of risk, and it is possible to lose all your capital. My name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so here's the agenda for today, right? As many of you who have been following the markets would be know, our chat is disabled. Okay. What about the Q&A, right? I believe even though the chat option will be disabled, I believe you can still engage via the Q&A box. Yeah, just drop your queries right in the Q&A box. Yeah, I believe the chat feature has been disabled. Nevertheless, you can still engage or ask your questions via the Q&A window. All right. I hope that helps, Juha. Yeah. Okay. So with many, I guess many of you have been following the commodity markets as well, and especially with oil, right? We've seen crude oil experience a very steep sell-off, not only in the first quarter of 2025, but in the second quarter as well, right? As we are now in the first week of May, or pretty much the second week of May now, right? We are also in the second week. We've also in the second quarter of 2025, right? So you can see volatility has increased for this commodity, and also we'll take a look at how President Donald Trump's energy and trade policies continue to impact oil prices as well. All right, so before we get into 2025, let's take a quick recap of what happened to oil in 2024. Right, we can see right, oil was already facing a challenging global macroeconomic environment. Right, there was already economic weakness at a global level, being experienced by everyone, right, by the major economies, right, particularly in China, where a weaker post-pandemic recovery, a cooling real estate market, and structural shift towards services and alternative energy reduce oil demand significantly. Right now, this broader economic slowdown exerted downward pressure on crude prices. Right, and then in the first half of 2024, right, there was pretty strong inflationary pressures, right, and that was one of the and which was primarily caused by elevated oil prices. Right, and also throughout 2024, geopolitical risks remained elevated. Right, tensions in the Middle East, such as the Israel-Iran conflict, as well as the Israel-Palestine conflict, as well, raised potential concerns about supply disruptions throughout 2024. Right, although the actual impact on oil flows were limited, but these uncertainties added to market volatility, and we saw prices spike periodically throughout 2024 as well. Right, there was also the aspect of, we also have to consider the aspect of production and supply dynamics, right? Throughout 2024, OPEC Plus implemented significant production cuts. They did this to keep prices supported, right? So, however, these cuts were offset by increasing production from non-OPEC countries, primarily the US, Canada, Brazil, and Guyana, with US output reaching record levels in October with 13.5 million barrels per day. Right, so you can see here, so throughout 2024, OPEC Plus had embarked on significant production cuts to prop up prices. But on the other side, on the other hand, we had major non-OPEC players such as the US and Canada ramping up production as well. Now, supply concerns, there was also, of course, right, despite OPEC Plus efforts to cut production, right, we also saw supply grow by 770,000 barrels per day in 2024 due to robust robust output from non-OPEC members. And of course, China's decelerating demand compounded the issues, right? Compounded the issues on the demand side, right? With China's oil demand growth having halved in 2024 as compared to the previous year. Now, OPEC directives as well, prolonged production cuts throughout 2024, help keep oil prices supported, right? And Saudi Arabia and Russia, of course, played the leading roles in these efforts. There was also some compliance challenges within the OPEC Plus members, right? Many members struggle with compliance due to fiscal pressures, leading to overproduction in countries such as Iraq and Kazakhstan. right? So the OPEC and OPEC Plus, of course, will continue to rebalance the market, right? But they face quite a lot of uncertainty, or they faced a lot of challenges throughout 2024. Now we can see here, this is the daily chart for crude oil futures for 2024. So you can see here in the first half of 2024, we did see oil prices accelerate. WTI oil, which began trading at around $70 per barrel at the beginning of 2024, surged as high as $87 per barrel, right? And then after that, we could see price uh, reverse quite sharply, right? All the way from the end of April or beginning of May, all the way down till September, we saw oil prices drop by nearly $20 as well, right? Pretty sharp decline in oil prices as well. Right, okay, yes. Of course, there's if you look at Africa as whole as a continent, and of course the whole of Asia, the rest of Asia as well. If you don't include China, there's also of course a lot of huge population, right? But it's also all about the demand as well. How many barrels of oil is being imported by these regions and by these countries, right? Having a huge population, right, doesn't necessarily mean that that particular country or that particular area or region is importing a lot of barrels, or consumption is significantly higher as well, right? So of course these countries and these regions will have an impact on overall supply as well. But these were just some of the main points to focus on in 2024. Right. Okay. So looking at oil prices, right? So we can see that volatility is no stranger to crude oil prices. We can see huge fluctuations along the way, right? We can see as quickly as oil price surge, they can fall just as sharply as well. And for most parts of 2024, right, especially from May onwards, oil prices were declining and they were down on the year as well. We can see here oil opening at about $71 per barrel in January of 2024. And by the final quarter, we could see that it was down on the year as well. Right, so we can see here, right, oil prices have always been subjected to high volatility throughout the years, right? This could be due to supply disruptions, production issues, geopolitical tensions, financial crisis as well, right? So volatility is no stranger to crude oil prices. Are not have always been subjected to higher volatility throughout time, and this is nothing new that what we've seen over the last few years as well. All right, so now let's come to 2025 and take a look at what was the general outlook for oil at the beginning of 2025, right? Once again, the similar theme was overall demand was slowing. Global oil demand was projected to grow by approximately 1.1 to 1.2 million barrels per day in 2025, driven primarily by non-OECD countries, particularly in China and India. However, this growth was modest compared to pre-pandemic levels. Now, from a supply point of view, right, once again, non-OPEC producers, right? The major players being Guyana, US, Canada, right? Were expected to add 1.4 to 1.5 million barrels per day in 2025. Right, and of course, price projections at the beginning of the year, right? Remember, this was all of this was prior to the ongoing trade uncertainties, right? The tariff uncertainties currently that's clouding the outlook not only for oil but also for global economic activity as well. Right, so price projections for WTI oil was forecasted to average between $67 and $69 per barrel in 2025 due to over supply surplus and modest demand growth. Right, so now let's take a quick recap of what happened in the first quarter of this year, right, which was basically January till the end of March, right? There's, of course, we've all been paying close attention to markets, right, and we see the steep sell-off in crude prices, right? This was driven by a combination of macroeconomic supply side and demand side factors. So, of course, beginning with the escalating trade tensions and tariffs, right? This is what is covering or splashed across all financial headlines, right? uh, over the last 6 to 8 weeks. So the announcement of new US tariffs, including a 10% universal tariffs of imports from all countries and higher tariffs on specific nations, for example, right, 25% on steel and aluminium products or aluminium, raw aluminium, and steel from Canada, Mexico, and the Eurozone, and additional 20% on Chinese exports, right? All of this sparked fears of global economic slowdowns. And of course, if the US has announced new tariffs, right, it is very likely its major trading partners are not going to sit back and accept these tariffs, right? We can also expect a lot of retaliatory actions uh, being taken by countries like China, the Eurozone, and others as well. Right, so all of this undermines global economic confidence and has dampened oil demand expectations as well. Now, the prospect of prolonged trade disputes and potential recession risks, right, have of course soured overall market sentiment, right, contributing a sharp decline in uh, commodity prices in general, especially for oil prices, and with WTI oil falling more than $15 per barrel to fall below $65 per barrel by mid-March. However, we've seen prices recover uh, quite steadily, right? With WTI oil rebounding to about $72 per barrel in early April before falling once again last week. Right. Once again, right? Okay. We also have to look at what are the directives from OPEC and OPEC Plus. Right, so just recently, right, OPEC Plus has announced plans to accelerate the unwinding of voluntary production cuts. Remember, throughout 2024, they did the opposite. They were uh, keeping ahead or keeping intact their voluntary production cuts, which means they were restricting supply. So by restricting supply, they were trying to keep prices supported. Now they're doing the opposite, which is actually somewhat flooding the market with more supply. And this is for them, particularly for countries such as Saudi Arabia, to gain market share while putting pressure on the other countries as well, or the other OPEC members. Now, the anticipated increase in supply from OPEC Plus members, alongside the continued robust non-OPEC Plus production, has added to further downward pressure on oil. Now, of course, we already knew that the global economy was slowing slightly in 2024, and it was also expected to slow even more at the beginning of this year. However, with the trade tariffs being imposed by the US, right? This has further weakened global demand as well. So the outlook has turned even more negative over the last 6 to 8 weeks, right? So oil demand growth, global oil demand growth for 2025 was revised downward by 300,000 barrels per day to 730,000 barrels per day due to fragile macroeconomic environment and, of course, escalating trade tensions, right? So this followed a robust consumption in the first quarter of this year, like pretty much I would say maybe till mid-March. But the outlook now has weakened, of course, as trade disputes intensified in April. However, as now we roll into May, it looks like there have been more positive news emerging from the White House, right, as the US seeks to negotiate with its trading partners and try to sort out better trade arrangements, right? We could potentially see, right, some of the tariffs actually being taken off the table, right, while we can still expect certain tariffs to remain, right? So although the worst is probably over for now, right? The worst is probably over. Actually, in April, we really saw the worst of the trade tariffs escalation. However, over the last 10 days or so, we've seen more positive news emerge from the White House. So perhaps um, we can probably expect markets to consolidate, right? We've also seen overall financial markets uh, uh, stabilize, right? We've seen equity markets stabilize and rebound very strongly. We've also seen volatility as measured by the VIX reduce quite drastically. So, of course, we're not completely out of the woods, but it looks like we're headed in the right direction. And if this trade tariffs can be resolved uh, amicably by both all parties involved over the next few months, we could probably see oil prices probably start to push a little higher, grind a little higher as well. But overall, right, the bias is still to the downside for now. Right, so China, which is the key driver of global oil demand, right, uh, we saw its latest economic indicators signal weakness as well, right? With CPI data, consumer price index, CPI data showing deflation, where CPI actually dropped 0.7% month over month, and PPI, which measures the level of inflation in the wholesale sector, right, which is producer price index, also registering deflation as well. Right, so despite stimulus measures from Beijing, right, over the last few months, stimulus measures have been enacted by Beijing since the end of last year. But despite that, deflationary pressures and uneconomic recovery have dampened oil demand expectations from the world's second largest economy as well. Now, weak refined fuel import demand and recession fears globally further weighed on prices as well. Right, inventory builds and market dynamics. Right, global oil inventories rose significantly, with a reported 150 million barrel build in onshore and floating storage since mid-February. Right, this build-up, combined with expectations of further inventory growth, right, signal an oversupplied market, pushing prices even lower. Right, WTI oil has recently hit four-year lows, right, dropping as low as $57 per barrel on 5th of May, right, which was down 10% from the prior week, and it has been down about 19% since the beginning of the year. But since the last couple of days, right, we've seen oil prices stabilize and rebound quite sharply, right? So it's probably down maybe about, I think, 16% now. Later on, when we go onto the charts, we'll take a look at exactly where WTI oil is trading. Right, market sentiment and volatility, right? Crude oil implied volatility spiked to 35%, right, in April 2025, right, as we saw the tariff escalation uh, uh, dominate headlines as well, right? So, and this led to growing concerns of economic slowdown instead of being concerned with supply disruptions, right? Also, over the same period, right, many analysts had warned of potential oil surplus, while weak economic data for the US and China exacerbated fears of lower demand as well. Remember, US and China are the world's two largest economies, right? And if these economies are expected to slow down or stagnate, right, this can have a huge impact on oil prices as well. Now, let's take a look at the outlook of for the second quarter of this year, right, which is basically going to be from May till the end of June. Oh, sorry, it's going to be from April till the end of June. Apologies, it'll be second quarter runs from, of course, April till June. Now, let's take a quick look at some price forecasts that have been projected by the various agencies and banks as well, right? So the US Energy Information Administration, EIA, has forecast Brent crude prices to average around $66 per barrel in 2025, with prices potentially falling down to $61 by the end of this year. Right, for the second quarter of this year, right, prices are expected to hover around the mid 60s, right, as we see inventories remaining elevated, and we also see global demand remaining weak. Now, Barclays, right, the British bank, has revised its Brent forecast down to $66 per barrel for 2025. Right, initially they had a price forecast of $70 per barrel, while ING predicts an average of $65 per barrel. Once again, right, everyone is pointing to mounting inventories as well as trade-related demand deterioration. A long forecast, which is another analytic company, right, predicts Brent prices could decline further, dropping under $58 per barrel in May of this year, and dropping under $52 by June as well, with WTI oil following a similar trend, expecting WTI oil dropping to about $52 in May and even lower in June, dropping under $49 per barrel. Now, supply dynamics, right? Global oil production once again is expected to increase, right, driven by OPEC plus, right? Remember, OPEC plus has just unwound its production cuts, right? Has just recently unwound its production cuts, which means that they're going to be injecting more supply to the market, combined with non-OPEC uh, supply as well, right? Robust non-OPEC supply, right? We are seeing the US maintain record high productions, right? Despite a potential slowdown in drilling activities due to low prices. Remember, when prices are typically lower, shale producers, it's not economically viable for many shale producers in the US to continue to drill, right? And so far, we have not really seen drilling activities slow down significantly, right? But nevertheless, if prices continue to remain low, or at current levels or trend even lower, right, we could see a lot of shale producers in the US come under significant pressure as well in terms of profitability, right? Now, demand expectations, once again, if trade disputes do not get resolved quickly and do not get resolved or do not, and or new trade deals are not formed uh, as robustly as possible, right, we could see demand continue to weaken as well, right? So global demand growth is expected to slow, right, with risk tilted to the downside, right, due to trade tensions and the fragile economic outlook. And of course, if trade negotiations falter, right, although we've seen more positive news emerge from the White House, right, but these trade negotiations have still not been formalized, right? There's nothing concrete being concluded. So if this takes a longer time to be resolved, this is all going to keep the overall sentiment or cloud the overall sentiment, and the bias for oil prices would remain to the downside as well. Now, China as well, right, its recovery remains critical to the overall demand picture, right? Although continued stimulus in housing, consumption, and monetary policy could help stabilize demand, but so far, right, deflationary pressures and weak inflation data suggest limited upside as well. Now, seasonal factors such as the summer season in the northern hemisphere, right, particularly in Europe and in North America, right, there's an increased demand for crude oil, or increased demand for petrol and gasoline due to the summer holidays, and typically a lot of summer holiday driving takes place over this period as well. Now, this usually helps. This would be actually it's quite a seasonal pickup in demand for gasoline and petrol over the summer here in the northern hemisphere, but in the current context, this may provide modest support, right? It is quite unlikely it will be enough to offset the broader bearish trends for oil prices. Right, inventory trends, right? Inventories are also building higher as well, further contributing to the downward pressure in price. And build up in inventories coupled with weak refined fuel demand will likely keep markets in surplus, reinforcing the bearish outlook. Right? Remember, the price of any commodity is always based on the basis of supply and demand. And of course, if we continue to see a surplus in supply while global demand continues to weaken, right, we can definitely, of course, expect prices to trend lower or remain under pressure. Now, of course, geopolitical and policy risks come into the play as well, right? Recent sanctions by the US on Russia and Iran has caused oil prices to spike as well, particularly in the beginning of January, right? At the end of December of last year and early January this year, we did see oil prices spike due to new sanctions imposed on Russia and Iran by the US, right? So, although the overall outlook for oil prices is to the downside, right? Nevertheless, geopolitical risks and new sanctions or any new sanctions that could be announced by the US are definitely going to inject a lot of volatility into oil markets, and we should be prepared that we are likely to see uh, spikes along the way as well. Now, potential disruptions to Russian exports or Venezuelan production, right, particularly with Chevron, the corporation, right, unwinding down its operations in Venezuela, right, this could provide temporary price support as well. Now, one of President Donald Trump's agenda to bring inflation down was to keep oil prices affordable, keeping oil prices low. And he embarked on an energy policy, right, which was to increase oil and gas production in the US. So his drill baby drill agenda, right, may encourage domestic production and increase in domestic production for oil and gas. However, right, a lot of suppliers, a lot of producers, particularly the shale producers in the US, face constraints from lower prices, right? It's not economically viable for them to continue drilling, uh, especially if WTI oil and crude oil prices, Brent and crude oil, WTI oil prices continue to fall lower. What is the situation overall? Okay, well, for right now, right, I've not really looked at what is the exact state of shale oil production in the US, but generally, right, if prices continue to trend lower, right, this is going to have a huge impact on their overall activity as well. So perhaps this is something that we can cover, right, in the next outlook, right, because we will probably do another outlook for oil in the next 1 or 2 months. So we can, at that presentation, I can take a look at what is the overall state of shale production in the US. Now, of course, as we all know, right, the current ongoing trade negotiations and the scope of tariffs remain fluid, right? Although uh, after announcing a huge range of tariffs on Liberation Day, which was on 2nd of April, right? The US also came out with a 90-day reprieve on some tariffs for many of its major trading partners, offering a window for resolution, right? Although everything is still, although on negotiations are still ongoing, and the situation remains very fluid, right? However, the longer trade policies take longer to be resolved, right? Or disputes take longer to be resolved, this is likely to keep the outlook negative, right? Keep the outlook negative and weaken overall demand as well. Now, impact of US policies, right? One of the key policies or energy policies by the US was to ramp up oil and gas production in the US, right? And typically, US shale production requires oil prices, WTI oil prices, to remain in the range of $65 to $70 per barrel for profitability, right? With current prices hovering below these levels, right? This significantly increases the likelihood that drilling activity could start to pull back. Now, market saturation as well. We have already seen in 2024 that US is already producing record volumes of crude oil, right? Leaving little room for further expansions without exacerbating the global supply glut. There's also been tariffs on Canadian oil, but right now this tariffs has been under the 90-day suspension, and this could, uh, and if these tariffs eventually do not get removed, right, they are going to definitely raise costs for U.S. refineries that rely on heavier grades of oil from Canada, right, and this is going to, of course, cause prices in the US to increase, countering the efforts to lower domestic energy prices. Now, geopolitical leverage, right? We all know Trump is always trying to use some sort of leverage over his opponents, right? Or over his trading partners. So Trump will continue to use oil as a geopolitical tool, right? Pressuring Russia over the Ukraine or influencing OPEC decisions as well, right? Right, now OPEC and OPEC Plus, right? So we've already seen OPEC Plus unwind its voluntary cuts of 2.2 million barrels per day starting in April, right? So that means we are expected to see more supply coming into the market, and this will continue for the whole remainder of this year and throughout 2026 as well, if there's no further changes, right? As quickly as or not quickly, while OPEC Plus has unwound its voluntary cuts, right? The situation is very fluid for them as well. We never know, maybe 2 or 3 months down the road, they could begin with voluntary production cuts once again. Right, so it's all uh, quite fluid for OPEC Plus as well, but nevertheless, at the present moment, we should be expecting for the supply to be coming into the market, well, from now all the way till late of 2026. Now, maintaining cohesion within OPEC Plus is one of the key tenets of Saudi Arabia as well, right? And this will be critical as well because lower prices strain fiscal budgets of member countries. Uh, not so much for Saudi Arabia, but more for Iraq and Kazakhstan, right? And non-compliance or disagreements among OPEC Plus members could lead to breakdown in production discipline. Right, also market stabilization goals, right? So OPEC Plus will likely to continue prioritizing backwardation, which is basically higher near-term prices of oil prices, right? You will have futures prices, near-term futures prices, and further back future prices. So backwardation means they would like to keep near-term prices slightly higher while managing crude stock levels below their five-year average to support prices as well. And of course, potential price for risk can also emerge, right? If US policies significantly disrupt market dynamics, OPEC Plus could resort to aggressive production increases as well, right? Triggering a price war similar to 2020, and also something which they had done back in, I believe, 2012, 2014 as well, right? OPEC Plus flooded the markets, right? Flooded the markets with excessive oil production to drive out a lot of US shale producers back then as well. This was about 10 years ago. Right, of course, key risks and uncertainties remain throughout 2025, right? Geopolitical instability is at the forefront, right? Escalating tensions in the Middle East or stricter enforcement of sanctions on Iran or Venezuela could reduce supply and push prices higher. And of course, economic downturns remain, right, especially with trade tariffs and slowing global GDP growth could weaken oil demand further as well. And we also can't ignore the technological shifts, right? The green shift or advances in renewable energy and electrical vehicle adoption may erode longer term demand, but this is something that's a far more long term projection. All right, so just to quickly conclude before we move on to the charts and trading view, right? So crude oil markets in 2025 will continue to remain under pressure if the current environment does not change noticeably, right? We are we are currently in a well-supplied market, right, driven by non-OPEC growth and tempered demand recovery as well, right? While U.S. policies aim to expand domestic production, this impact may be limited by economic realities and profitability constraints as well. OPEC Plus, right, will of course continue its cautious production management strategy, but faces risk of internal discord and external competition. Now, just to conclude, in Q1, in the first quarter of this year, the crude oil sell-off was triggered by escalating trade tensions, OPEC plus production increases, weak global demand, rising inventories. In the second quarter of this year, right, we are sort of halfway through the second quarter of this year. The outlook continues to remain bearish, right, amidst growing supply and subdued demand growth. While geopolitical risk and Chinese stimulus could provide some upside, right, the overall trend, the overall dominant trend, but continues to point towards downward pressure unless supply constraints or demand recovery materialize. Right, so as investors, as traders, we should always continue to monitor the ongoing trade negotiations between the White House and the US and its trading partners, right, OPEC plus decisions, and look at how China's economy is evolving, and also what are the new stimulus measures, if any, that are being announced by them as well. All right, okay, so with that, now let's move on over to the charts on TradingView and take a look at where WTI oil is currently trading. Right, so here I am on the daily time frame. I'm on crude oil futures, on the chart for crude oil futures, and we can see that oil began trading. Oil opened at $71.85 per barrel on 2nd of January, and we saw prices surge quite strongly. Right, this was primarily due to the surge or the new sanctions that were imposed on Russia and Venezuela as well in the beginning of January. So we saw oil prices surge about 12% from the first day of January. But if you look at it since December, oil prices surged nearly 20%. So huge increase in oil, a huge surge in oil prices, WTI oil, in the beginning of January. But remember, after Trump's inauguration, which was on 20th of January, President Donald Trump assumed office on 20th of January, where he announced his drill baby drill agenda, right, his US policy agenda. And since that date, we've actually seen oil prices tank, right? We've seen oil prices dive since his announcement, and they've not recovered. Remember, 20th of January was a bank holiday in the US, so markets were closed, and markets resumed trading on the 21st. Right, since then, you can see oil prices have tumbled, right, from 20th of Jan till its lowest point, which was on 9th of April. Oil prices at WTI oil had fallen almost 29%, right? And even now as well, at the end of April till 5th of May, oil prices tumbled once more, right, dropping as much as 13%. But over the last 3 days, right, we've seen oil prices recover quite steadily as well, right? Remember, although the overall trend is to the downside, right, due to a combination of perhaps profit taking and changes in or increased geopolitical risk, we can always see oil prices stabilize and climb higher as well. So we've seen a retracement to the upside as well in the second week of March till the first week of April, and we've seen another retracement to the upside as well in 10th of April till the end of April, and we are likely to see another retracement to the upside as well. Now, this increase in price can be caused by several factors. One is profit taking as well. Remember, as short traders close out their trades, right, for them to capitalize on their short trades, they need to close it out and buy back the commodity. That can drive prices up as well. and that would create a bear flag along the way. So here we have a very nice bear flag that was formed on 10th of March till the first week of April. But this was a very nice bear flag which finally gave way on 3rd of April. We also had another pretty decent bear flag that was formed between 9th of April and the 29th of April as well, another decent bear flag being formed. And currently now, I would say we are probably in the midst of another bear flag in progress as well. Now, how far this bear flag is going to rise up is anyone's guess. But we can see here, right, although we've seen crude oil prices dive considerably since the beginning of the year and at various points over the first few months, we have also seen very strong retracements to the upside as well. For example, this retracement here from in March was as high as 10%. And even this one here in April, if you take it from its lowest point to the highest here, this rebound was as high as 17%. Right. So nevertheless, right, although we are seeing a lot of overhead pressure, we're seeing very weak fundamentals for oil, right? Uh, it doesn't mean that we can't expect strong retracements to the upside. So it's not as simply as shorting oil every single time. You have to be really cautious because we can see that this commodity is always subject to high volatility, and we can expect to see bear flags like these being formed periodically throughout 2025 as well. If you look at 2024, there were quite a few bear flags that were being formed as well, right? You can see here, even in August, a very strong rebound here before price finally fell. Another strong rebound before price dropped significantly lower as well. So once again, right, do not get caught out, right? Do not get caught out uh, by shorting oil, right? Although the fundamentals are poor and the outlook doesn't look, uh, the outlook for 2025 is not very bright. Nevertheless, don't go shorting oil blindly because you can really get caught out with this strong retracements to the upside. Now, this retracement here, the current retracement, you look at it, right? We actually had identified RSI bearish divergence, right? So if you look at it here, I'm on the daily time frame. I have the RSI in the middle panel. I have the stochastic oscillator on the bottom panel here. Now for RSI divergence, right? This is something that we spot when we see the RSI make a higher low, right? As you can see here, the green dotted line, right? The green dotted line shows the RSI moving from 26.32 on 8th of April to going to 32.97 on the 5th of May. Over this same period, we actually see oil prices trending lower, right? We see oil prices trending lower here. Now, this is what we would call RSI bullish divergence, right? So bullish divergence means price is trending lower, right? Over these two periods, which is 8th of April and 5th of May, right? Over between these two dates, we see price generally moving lower, but we've actually seen the RSI make a new low. So this means RSI is climbing higher, gaining in strength, while prices are dropping lower. This is what we call an RSI bullish divergence. And typically, we can see prices start to climb higher as well. So you would see this if we do spot this RSI bullish divergence on the daily time frame, weekly time frame, or even the 4 or 1 hour time frame. Typically, we can expect prices to make a strong retracement to the upside as well. Right, so this is something that was spotted at the beginning of this week, right? Right, as I spotted at the beginning of this week, and since then we've seen oil prices rebound quite strongly, right? If you don't include Monday, right? Since Monday's close till now, oil prices have climbed almost 5.5%, right? Pretty strong rebound in a couple of days. Right, okay, let's see if there's any other divergences to take note of. Right, just as we have a RSI bearish divergence, we can also have a just as we have an RSI bullish divergence, which is what we've seen between 8th of April and 5th of May. We can also spot RSI bearish divergence, and this was something that was spotted in January. So you can see here in January, prices made a new high, right? WTI oil prices made a new high, but the RSI actually made a new low. So this is what we call an RSI bearish divergence. And typically when the divergence like this is spotted, typically it can lead to a bearish reversal, which is what has played out since 16th of January. So you can see here since 16th of Jan, after the bearish divergence has been spotted, right? Oil prices dropped as much as 17% over a couple of months, right? Over a period of 2 months, dropping as much as 18%. So these divergences are important to take note of, right? Whether we spot it on the weekly time frame, daily time frame, or H4 or H1 time frames is something to be aware of as well, right? Because it does typically lead to a reversal. So in this case here, between 13th of Jan and 16 and 13 and 15 of Jan, there was an RSI bearish divergence that was spotted, typically leading to a downturn in prices, which is what has played out quite nicely. And as recently as Monday, right, there was a bullish divergence being spotted between 8 of 8th of April and 5th of May, and typically we can expect a bullish reversal to materialize, which is what seems to be happening at the present moment. So take note, right, whether we are on a weekly, daily, H4, H1 time frame, spotting divergences at this are important, right, because they can really help to identify a potential reversal in prices. And imagine if you're long oil here, right? Imagine if you're long oil since the beginning of January, and if we didn't spot this bearish divergence, we would not have uh, exited the trade earlier, right? Maybe by spotting the divergence, right? You could exit the trade outright, or you could manage your stop loss and trail it a little bit more closer than you would typically have done previously. And at the same time, by spotting this bullish divergence, imagine if you're short here on oil since the end of April, and then suddenly on Monday, I spotted the uh, uh, bullish divergence. This was my signal telling me, all right, maybe I should exit my short trade, book as much profits as I can now, and let's see how far or how high prices are going to rebound, right? So this is important to spot these divergences as well. Maybe we may not use it to enter a new trade, but we should definitely be using it to exit the current ongoing trade as well, right? So back in January, right, very strong rise in oil prices. After spotting the bearish divergence, we should be looking to exit the long trade or maybe manage the stop loss a little bit more closer. Conversely, after spotting the bullish divergence at the beginning of this week, right, I would be looking to either close out my short position outright, or I would be trailing my stop loss much closer, and right, and probably would have been exited the trade um, on Tuesday. Right. Okay. So these are divergences that are important to take note of. Let's see if there's anything that we can spot like on a higher time frame. Here, weekly time frame before we go down to the lower time frames. Let me see if there's anything else. No, weekly, not so much. On the daily, these are the two most recent divergences that were spotted. Let me see if there's any other examples for you guys for us to work on. Probably just a quick note here, probably not. I don't really see. Okay, there was one divergence in August of last year, right? This was a bullish divergence. Generally, here we can see price making uh, a new low, right? While the RSI was moving higher, right? This was a bullish divergence, and we actually saw price reverse very sharply, right? So we saw price re rebound as much as 8%. So imagine if you're shorting oil since mid-August, right? And after spotting the divergence, right, this would be telling me, okay, I should be looking to exit my short trades at this point here as well. So you can see here how spotting the bullish divergences help us exit the short trades as well. Right, anything else on the H4 time frame? Probably not. Okay, so let's come back to see where oil is currently trading. Let's look at the H4 time frame and see if we can spot any more divergences. No, okay. As of now, right, I don't really see. Of course, we just spotted one recently here, but let's just see anything else that I can spot. No, probably not. Okay, so that's fine, right? Now let's try and establish what are key resistance and support levels for crude oil, right? Because that's going to be important as well. Okay, so let me get rid of these markers here. All right. Okay. Now, in terms of resistance, right, if we know that the overall outlook for oil is to the downside, right, where could we expect oil prices to run into resistance, right? So we can see here not only is prices continue to trade underneath the red Ichimoku cloud, we can see that the cloud itself can function as an area of resistance as well. So as this retracement was being formed, right, we saw crude oil, WTI oil run into resistance at pretty much the cloud, and then it broke out of the bear flag, and we saw the downside accelerate even further. So that's our first area of resistance as well. The cloud, the red Ichimoku cloud itself can be an area of resistance. We can also use a Fibonacci retracement on this downtrend here, right? We have a nice downtrend beginning from 23rd of April, going down to the low of 5th of May. Perhaps you could see some resistance being formed around the 50 and 61.8% retracements, right? We can already see crude oil has climbed above 23 to 38% retracements, 50 and 61 at these levels here. So this could be our first area of resistance as well, right? We have a nice, pretty decent resistance that we can identify in this region here between the 50 and 61.8% Fibonacci retracement. And of course, I see a strong barrier here, right? We can see price being stalled at around $64 per barrel. This is very clearly where a major resistance also sits at. Right, so let's just identify this as as one resistance level here, right? And then let's look at WTI oil on the 4-hour time frame. Now on the 4-hour time frame, there is, I would say, a pretty decent overlap level as well. A pretty decent overlap level here at around $61.50. This is also where we could see this region here. So on the H4 time frame, we can see that the cloud sits a little bit closer to price. So if we do see WTI oil head into this 50 into this zone here, this is probably where I think we could expect pressure the recent rebound to face some strong headwinds, and we do see price stall here and then reverse to drop lower, right? Especially if it breaks out of this sort of bear flag that's currently being formed, right? Maybe we are in the midst of a bear flag here, right? So if we do see WTI oil stall in this zone that's identified between the 50 and 61.8% Fibonacci retracements, and I also, especially if we see it break out of this flag here, right, we're likely to see another nice bearish breakout opportunity, right? We're likely to see another nice bearish breakout opportunity. Now, on the other hand, I would also want to identify a potential overbought condition, right? An overbought condition is when the RSI is relatively high, the stochastic oscillator is relatively high, something that we saw on 2nd of April, right? On 2nd of April, we saw the RSI, the stochastic oscillator here, which is the lower pain, hitting about 91, RSI hitting about 62, and we saw price enter the red Ichimoku cloud on a daily time frame, right? All of them highlighting a potential resistance, a very strong resistance, and we did see price break out of the bear flag and drop significantly lower. So perhaps a similar scenario, right? If we do see the RSI continue to climb higher, right? Remember the last time WTI oil ran into resistance was around $64 per barrel, and at that time, RSI was around 47, and stochastic oscillator was around 49, right? So we're not there just yet, but if we do see prices enter the zone that's defined by the 50 and 61.8% Fibonacci retracements, and at the same time on the daily time frame, we see the RSI pushing against 50 and the stochastic oscillator also pushing against 50. Perhaps that's also a sign that we can expect prices to slow down, right? The rise to slow down, and we may have a potential bearish reversal set up within this zone. And especially if price, right, if price breaks through the flag here, right, that's definitely going to see the downside accelerate as well. So in the current scenario, oil prices have rebounded quite strongly this week. However, it could run into resistance at around $61 per barrel. And especially if we do see the RSI and stochastic oscillator hit their respective thresholds here, right, we could probably see prices slow down, run out of steam, and make another bearish reversal. Now looking at the H4 time frame, right, on the H4 time frame, right, you can see here on 22nd of April, we saw the stochastic oscillator hit about 86. We also saw the RSI hit about 51, and we saw the WTI oil fail to break above $64.50 convincingly, right, since 16th of April. till 23rd of April, right? WTI oil failed to break above $64.10 convincingly, and we did see a nice reversal being formed, right? A nice reversal being played out, and especially with price breaking out of the bear flag, here we saw the downside accelerate. So even after breaking out of the bear flag, right, if you don't catch it on the first day, right, let's just say we missed it on the first day, even from the second day onwards, right, oil prices continue to drop 8%. So don't worry, right? Typically, even if you do miss the exact breakout, right, there's usually the momentum is going to be strong, and usually there's still time to try and capitalize on the downfall here, right? So don't worry, you don't have to catch it at exactly the breakout point, or you don't have to catch it at exactly the top. But remember, when we see the downside accelerate, that's when we're really trying to catch the fall in oil prices. All right, okay. As we come towards the end of today's session, right, are there any questions with regard to what we've covered so far? I'll be more than happy to answer your queries with what we've covered, or if there's any technical analysis questions related as well on crude oil charts, I'll be more than happy to go through that with you. In the meantime, I'm just going to launch a poll as well. Really appreciate it if you guys can give your feedback with regards to today's webinar, and then I'll be, we'll just conclude by answering your questions or any other technical analysis related queries you may have. All right, keep the poll running for another 20 seconds or so. All right, great to see all the responses coming in. Right, just give it another 10 more seconds. All right, great. I think that's most of you have voted. All right, great. Truly appreciate it. Mm. All right, okay. If there's no further questions, then let's just come back to the daily time frame on oil. Remember, yep, we have a first major, I would say, the first major resistance at around $64 per barrel. Right, we also have an intermediate resistance zone that's being highlighted by the 50 and 61.8% Fibonacci retracements. We have also spotted a somewhat development of a bear flag, quite similar to the flags that were formed between 9th of April and 28th of April, and also similar to the flag that was formed between 11th of March and 2nd of April as well, right? So take note, right, as despite poor fundamentals, despite a negative outlook for oil prices, we are always likely to see strong retracements to the upside, right, due to short covering, due to geopolitical risk. This is something that we've seen throughout 2024 as well, right? So don't get caught out by strong reversals, strong bullish reversals. And also remember, we had also spotted bearish and bullish divergences on the daily time frame, right? Take note, it's important to spot these sort of divergences as well, because it helps us to exit the short trades, right? And not be aggressively short. And at the same time, it can also help us to exit long trades as well. Right? It's important to spot these divergences and also to take note of overbought and oversold conditions, right? For example, this is an hang on. This is an overbought condition being highlighted by the RSI and the stochastic oscillator on the daily time frame. Similarly, we also have an oversold condition being highlighted by the RSI and the stochastic oscillator. So typically when we spot conditions such as this, an impending reversal could take place, and especially if you spot it alongside the RSI divergences, it adds further or it increases the probability of that reversal actually playing out. All right, okay, so that's all I've got for you guys today, right? Thanks everyone for tuning in to today's session brought to you by IronFX. Right, do look out for all upcoming webinars from the remainder of this week. We've got another session tomorrow as well on Thursday, so do look out for that webinar as well. All right, thanks everyone. Take care. Have a great trading week, and catch you all in the next session. All right, thanks everyone. Take care.